And today I'm going to talk about two most basic data streams in any time series, returns and volatility, and my new discoveries of those two data streams during my research and research more about a intraday low latency predictive model in currency. And my renewed look of these two data streams, as well as my reflection about what I learned. So we all know that returns and volatilities are related, but in live markets, especially intraday currency and equities, the link keeps vanishing. And when we try to forecast them, today I will show why that happens and what actually helps. Oops, sorry. I just messed up. Let me see. There we go. There you go. All right. Forward button here. The first thing we learned from financial engineering 101 is what is volatility? Well, volatility is a standard deviation of returns, which is the square root of the variance of returns. We all accepted it. It makes sense. And we use it in many risk metrics and modelings. But when I look into real-time intraday predictions, this relationship doesn't hold on a tick-by-tick contemporaneous basis. It puzzles me. The model prediction, the model quality between returns and volatility was so different. So I was thinking, how come a causal correlation, a causal mathematical link can be so broken in intraday predictions? So mathematically, we went through the mathematical causal relationships, but the math is tight, but intraday prediction is not. The first thing I noticed when I went through different levels of techniques, from linear ARIMA, EGARCH, to machine learning, to deep learning, between return and volatility is I couldn't have any prediction on returns, full stop. But volatility actually has some structures. And either model sophistication you choose, you can get some good quality volatility predictions, but not on returns. So it definitely breaks the causal link in the mathematical model, right? And so I looked into why that's the case. Why in short-term, tick-by-tick contemporaneous environment, this causal relationship just breaks down? Well, it actually has a very good thesis behind it. In real time, returns are affected by short-term microstructures, by bid-offer imbalances, by news, and all of those events affect returns in an unpredictable, random way. But they all cause volatilities to surge. So there is a saying that volatility is clustered. That clustered actually means volatility has a structure. And with structure, we can do some good work in prediction. So if we can have simple correlation between the two, then we would have harvested it. But on a tick-by-tick basis, let's see if the model's goal is to predict the next minute for both return and volatility. I don't see any stable causality or correlation between the two at all. So that makes me the first decision I made is we definitely need two different models to predict them. We cannot infer one from the other. The second thing when I thought about this was, let me actually test if raw return is white noise or not. Does it actually have structures? So before we do that, oh yeah, there we go. So this is what efficiency looks like in real time, in intraday. That's a return prediction. It's a flat line. So if we're saying your prediction model is a flat line, why not just take the mean, the sample mean, and call it a day, right? I looked at this, was okay, what to do? I got this prediction in any modeling techniques I choose. It doesn't matter how sophisticated, nonlinear, nonlinear, linear, nonlinear. It's the same results. But with volatility, even with a simple EGARCH econometrics model, you can see it has some structures, and it captures ups and downs. So there are two different behavior between return and volatility. Completely breaks down the causal mathematical relationship there. Yeah, so before we go into further, delve into what to do then? Do we just give up on returns? Let's differentiating two big concepts in time series, which is white noise versus stationarity. So sometimes we kind of talk about these two things in one context. They're actually kind of overlapping, but very different. So both means a constant mean and variance, both white noise and stationary. But if a time data stream is only stationary, but without structure, without autocorrelation, it has no predictive power. So to enter the space, we all have to be stationary, but it cannot be white noise. But sometimes we also say white noise is a good thing. And when is that? That's actually when we talk about residuals. Right? After we model this residual, and if the residual is white noise, it's a good thing. But for raw data time series, if it was white noise to begin with, we need to work on it, or just give it up. So what do? Do I give up on returns? Oh yeah, so here, So here is the actual data to back up my claims. On the chart, the top two are all returns, log returns of the raw price. And you can see by the white noise Longin box test, they all have no autocorrelations. Versus volatility, you can calculate by high-low volatility or any other volatility methodologies. They all have immediate high correlations, autocorrelations there. So Longin box actually proved that raw returns doesn't have autocorrelation. That's why it's a flat line. And then volatility has structure. That's why the most basic econometrics model can actually highlight some of the structures. So do we just give up? I thought about giving up on returns. And because the literature also said short-term returns are random noise and there's nothing to do there. But if we give up, we just fall into the majorities of what's out there already, right? Which is we can only work with volatilities and just give up on returns. Well, before giving up, I read literatures and all the recommendations, and I came into this denoising, smoothing technique. Because with the smooth, if we have raw returns that is white noise, but there's lots of different smoothing techniques can actually accentuate the underlying structures and take out the noise level, and we can model the underlying long-term structures. So that's what I choose to do. There are many different types, but the ones I choose to focus on is the ones I highlighted here, which is a wavelet transformer, exponential moving average, and finally Kalman filter. And I will talk about how I went through them and what was the eventual choice I had and why I made the final choice. So the goal is again to decompose the raw return into different frequency space to hopefully to find a long-term, more stable, non-white noise structure to model that and discard the high frequencies. Let's see if that's successful. All right. Okay, so the first is wavelet. It was highly recommended in a few financial literatures. And the wavelets have many different families. The one that was highly recommended for specific currency space is Simlet, SIM15 at level 4. So what wavelet does is it really decomposes raw data into different frequencies. And we always grab the lowest frequency because that's our core frequency. And then we choose to include, if we want to include more noise levels, we can do that. But 4 means it has 4 levels of those frequencies. And in addition to SIM15, there's also Debauchy, wavelet, which is Debachi is the name of the wavelet inventor. She works at Duke University. Lots of credit and respect for her to come up with this technology. So the difference between Simlet and Debachi is actually significant, because Simlet it offers symmetries. When we come up with a calculated coefficient, it offers symmetries between across the. It offers symmetries next to the coefficient, but Debachi actually doesn't look at the other side. It only looks at the past data points to now. So Debachi is actually causal, and Simlet is not. So let's just unwind a little bit back to the financial literatures I was talking about. A lot of them was recommend Simlet. And why is that? The accuracy is much higher in the prediction, in the research platform. And why is that? Because Simlet is actually not non-causal. When it comes up with those coefficients to denoise the raw data, it looks into the future because it's symmetry. You may ask, let me go back. Yeah, you may ask, what future is it looking at? Right. It's looking at when it comes with those coefficients. It's not just calculating coefficients from the coefficients data from the past. It's also pad itself with data in the future. So those coefficients has a look-ahead biases. Therefore, Simlet offers the highest accuracy after denoising, versus Debachi doesn't. Let me go back here. When Debachi doesn't. So I actually found out the hard way, because you always go with the highest accuracy prediction ones. And I was able to replicate the financial results on the white paper. I was like, no one else knew about this? You have high accuracy way beyond random guessing, right? And I found out about this look-ahead biases because it was so subtle. Regular look-ahead biases tests doesn't catch it. However, once you go into production, there's no future data points for you to for the Simlet to come up with a coefficient, right? So immediately the model prediction breaks down in production. In research, if you think, okay, this is my training data set, and I want to calculate coefficient here, the data is still here. The future data is here, so it calculates coefficient looking at both past and future. In production, this data is not there, so it couldn't find out the same same coefficient in production versus in research. Immediate breakdown, and that's when I found Debachi. I found, okay, fine. I was like, okay, fine. Let me switch to a different wavelet. So Debachi also offers pretty good prediction accuracy. It's a little bit lower than Simlet. And shall we go with it? Well, it turns out it is also very difficult to replicate even Debachi in production. The reason is the coefficient calculation is highly context sensitive, meaning if I want to calculate coefficient here, and in my research, my test data is from here, my test data for training data from here, but my history is, let's say, 6 months. It will use all the 6 months, calculate this coefficient. And this calculation will be different in production versus your calibration may be much smaller window. It can be the same data point, but given a much smaller window, it'll give you a different coefficient. So it's near impossible to replicate those same parameters in production versus in research. And we just couldn't do it because if we cannot justify our research results in production and we cannot make sure they're always replicatable, we just have to give up. So I gave up. I moved on to some other techniques. The next one, I'm like, okay, I spent a month on wavelet. I went through the highs and lows. The next one, let me try a simple one. So moving average, exponential moving average is a staple in financial time series smoothing. It's essentially a weighted average where recent price gets more emphasis and old price faded away exponentially. So it's easy to explain to folks, and it's easy to recalibrate. There's only one dial. The dial is called a span, which is the rolling window. And the span usually dials how responsiveness we want the smooth data to be. So easy to set up. But immediately, what I found the drawback of exponential moving average is the lagging nature. It's very lagged. It's not responsive. And in the very low latency, high frequency space, a lagged indicator, a lagged feature is not very helpful. So then I tried different variations of exponential moving average, which adjusts the responsiveness of exponential moving average, but there's no free lunch. When the responsiveness comes back, the noise also comes back. So the noise is back. Well, the whole purpose of smoothing is to take out the noise, but then when we make the moving average setup more responsive, the noise also comes back. So when we're choosing the EMA variant, it's all about balancing smoothness and timeliness. And the span or rolling window is the only thing we can adjust. But the predictability, the prediction quality definitely dropped quite a bit with a lagging technique. So then I said, okay, I have to bite the bullet and use Kalman filter. Kalman filter is a very solid foundation, but applying it is actually not, because you have to come up with all those parameter matrix yourself, do the calibration yourself. But this is the technique that actually fits the space. It's adaptive, it's causal, and it can be calculated cheaply in the real-time environment. And with Kalman filter, it's all about a blend of two different dials. One is, do I trust my model more, or do I trust my observation more, the market reaction more? If I trust the market reaction more, I will react more responsively to the market observation. And if I trust my model more, I will keep the same prediction that my model predicts. So it's really a dial between the two. It's entanglement between the two. And the key part of a Kalman filter is something called Kalman gain. And Kalman gain will be high if the market is less noisy. If the market has a deterministic move, then it means it's less noisy. And then it has a high Kalman gain, and we want to follow the market observation. When the market is noisy, which it's a variable called R, the R variance is very noisy, and then Kalman gain is low, and we want to follow the model prediction. So in theory, it's a very good framework. And that's eventually what I did. And the next two slides are more like my study notes. What I found is very useful to have. I think the most useful to have is how the two knobs, Q and R, change behavior. So why are we doing smoothing? We're doing smoothing because we don't want to follow the noise. So if the market is exhibiting high noise, we actually want to follow the model because we don't want the noise, the microstructure noise, to impact our judgment. But when the market is less noise, then we actually want less smoothing because we want to follow the market because the observation is actually very deterministic and has high conviction behind it. Here's just more notes here. Repeating notes from my previous slide. All right, so let's see what happens after I apply this. So I tried all those techniques, and what happened to my denoise return? Voila, it's all green. They all have high autocorrelation. So eventually, I tortured the raw data and make it into structured, from white noise into a structured data stream. Am I done? I'm like, can I just say yes, victory, and we have a prediction powers here, and our model is going to work really well? Well, what's the next challenge? With the high autocorrelation from the noise data actually also has its hidden trickiness. Right? First of all, we need to be very careful. What are we smoothing? We should only smooth the features, not the target. Because if we smooth the target, what you see here on the left side, the correlation is extremely high. The feature and the target is extremely high. But smooth the target is completely useless in production. Because in production, we actually cannot smooth the target. We cannot smooth the return. There was a different occasion when I was using lots of vendor data. At one point, I was very happy because it was abundant, it was very clean, and the model has a good predictive power. But it turned out the data has already been cleaned, has already been smoothed. So if you use clean data to begin with in your space, your target is already cleaned. And you have to be very aware of those subtleties. And again, the model is not very predictive when it applies to raw data. Right? So just be mindful to only smooth the features. And so after smoothing the features, the right-hand side chat comes up. Again, wavelets took the top crown, right? But we all know the drawdowns of wavelets now. It's either has look-ahead biases in simulate or has a context sensitivity in debauching. So the next one I chose, the next one on the leaderboard is after Kalman, and that's the one I decided to use. Yeah, so that's that's pretty much my decision, my thought and decision process. Why I use Kalman, even though it wasn't easy to calibrate, because if you think about to calibrate R and the Qs. Right, R is a representing market, which is relatively easier to model. We can run some time series of returns and calculating its jumps and standard deviations for R. But for Q, it's about your model noise. So to calculate your model noise, you actually have to run the model, take the results, and look in the results. And we need to recalibrating Q and R. Ideally, real time, as part of the model. So real time, we can look at every rolling windows and recalibrate Q&R. That's how adaptive we need to be, right? Otherwise, again, regime changes shift quickly in low latency field. Without real time recalibration, it's again nearly not very useful. So there you go. All right. So after denoising, what to do? Definitely time to build a model, right? Time to harvest. So this is on a high level what the model pipeline looks like. So the raw data input is just market data, and bring them into any time rolling windows you want to bring them. Like it can be minutes, can be n number of microseconds if we choose to, or days. So every row is a binged high-low open close, and then going through the denoising for Kalman filter, and then feature engineering. Feature engineering is very important in low latency space because the feature needs to capture what's going on, needs to be accentuate what's going on, and also what might likely to happen as a next step. So lots of low latency features, mostly technical, but not just technical as in relative strength indicator or Bollinger Band, but also technical as in the first diffing, second diffing, skew, kurtosis, all that space. And then build a target. My choice of return prediction is a classification model, and the volatility is a quantile regression model. So classification model for returns, it's easier to think up and down and flat. But also, the one beautiful thing about classification model is it doesn't actually give you a prediction. It gives you the probability of each class. So then you have to come up with a the calibration to say, okay, exactly how I choose to decide whether it's up and down or flat. So that itself is a calibration process. And so one thing that's worth mentioning here is, in addition to manually created feature, I also included deep learning features, which is the next slide. So prior to this experience, I don't have lots of convictions in using convolution network, because ConvNet is for images. To me, time series is not image. But the underlying theory is actually very compelling. So ConvNet is using a matrix convolution methodology, using a smaller filter to scan through your bigger time series matrix. So it can look at cross feature and cross timeline. And what it produces is a grayscale. Grayscale means it lights up and dims down. So it will help you to look at volatility and returns about what if they both go up and what next happens. So it really is computer vision. It's a feature that cannot be handcrafted. And I choose to use them. And my Shapley value, which is the chat towards the far right, has some backends to that, because all the ResNet or the deep learning features has much higher feature importance versus the manually created features. So I included them in my model. All right, it's not a flat line anymore. It looks like up and downs, but because this is a classification model, not a regression, so you don't see lines. But if you look at the accuracy and prediction and balance F1 scores, this is the 3 classes. So 3 classes, default is 33%, 33.33%, but they all beat the 33.33%. So it beats the baseline. And this is in a space that I did not think it was predictable. It's a return space I didn't think it was predictable just a month ago. So we're getting somewhere. We still have work to do, but we're getting somewhere. And we're seeing some encouraging results. And this is the volatility from quantile regressions. Quantile regression really makes sense to me here, because it can draw a more bankable intervals, like 10 percentile, 90 percentile, and also a mean prediction. So those are from the same model, 2 different outputs. Yeah, so what's the takeaway? Well, takeaway was, I was really puzzled by this mathematical causality link and the complete disconnect between returns and volatility to begin with. And throughout the journey, I learned why they're different and why they all make sense. So the mathematical model is really for long-term relationships, and for so in long-term relationships, what does that mean? It means sometimes volatilities and returns do connect with each other. Like high volatilities can cause more negative returns, and more negative returns may cause high volatilities. But they don't happen in contemporaneous rhythm. They happen within lags. And on a longer term, it definitely makes sense that, well, if my portfolio never changes, never have returns, I have no volatility, right? It also makes sense. But in microstructure, lots of microstructural factors that are affecting returns is affecting volatility in a different way, given a different structure. And and the other take back I will have is just keep digging, and if your results proved to be you can replicate white paper but turn out to be not really production reproducible, you're not the only one. Thank you.